Mom was that way. Let me come home crying over something, and she'd give me candy every time.
When you see the stock market come down and the real estate bubble burst, all that phony wealth is going to evaporate. And all that's going to be left is all the debt that we accumulated to foreigners.
Peter Schiff is another analyst who was roundly mocked when he predicted a crisis for the US economy in the midst of the boom.
We went on an unprecedented global spending binge. American citizens borrowed and spent trillions of dollars to buy stuff. And that is why we're in so much trouble. It was because we got drunk on all that fed alcohol. Fed alcohol. Fed alcohol.
In a world that was suddenly uncertain, with the country under attack, nothing felt safer than investing in your own home, in the American dream.
I do believe in the American dream. I believe there is such a thing as the American dream. Owning a home is a part of that dream. It just is. Right here in America, if you own your own home, you're realizing the American dream.
Vernon Smith was awarded the Nobel Prize in Economics in 2002. He received it for his research in experimental economics. In his experiments, he puts economic theories to the test. Smith is an expert on bubbles.
If you can buy a home with almost nothing down, then you do well if the prices continue to go up. If it goes down, well, then you have an incentive to walk away from it and let the bank have it.
Low interest rates caused a housing bubble. Cheap loans encouraged people to buy more and bigger homes. Housing prices began to rise by 10% a year. So many took out a second mortgage on their old house to fund consumption.
You want to go on that vacation? Buy some new clothes? How about putting an addition on your house? You don't have the money? How about a home equity loan? That's for you. Let's use your house as a piggy bank.
The banks granted loans to almost anyone. Why would you need a decent income to buy a home if you can get rich just living in it? The market even coined the term Nina loans. No income, no assets, no problem. You'll get a loan anyway.
The legislation was more aggressively pushing lenders to lend to people of modest means, people whose incomes were 80% of the median income or below.
Politicians encouraged this. For a long time, both the left and the right have been encouraging home ownership. So they've created deductions, subsidies, and insurances. And they created two huge mortgage financing companies, Fannie Mae and Freddie Mac. Their job was to use thousands of billions of dollars to insure loans for people who couldn't get them on the open market. They were government-sponsored enterprises. They had private owners, but they had been created by Congress, and their transactions were guaranteed by the government.
So particularly Fannie Mae and Freddie Mac are government-sponsored enterprises. And what it means is they're private, not now maybe, but they're private companies that have special charters from the government. And the thing about government-sponsored enterprises, which is the main thing people are talking about, is a sense that they're guaranteed by the government.
First of all, government-sponsored corporations that help create our mortgage system. I introduced two of the leaders here today. They call those people Fannie Mae and Freddie Mac, as well as the federal home loan banks, will increase their commitment to minority markets by more than $440 billion.
In the last decade, Fannie Mae and Freddie Mac have donated more than $200 million to politicians in Washington. Enterprise-sponsored government. I asked the former Freddie Mac chief economist what they got for their money.
I don't know. I mean, that's a tougher question. They had a pretty good charter. They were regulated in a spotty way. In many ways, the regulatory structure wasn't that bad, but it was the case that the regulatory structure was a compromise. It wasn't a treasury, it wasn't a housing, really. It was somewhere in between.
You know, there was a huge moral hazard courtesy of the government in the mortgage market. When the government, through Fannie and Freddie, started to guarantee mortgages, then the lenders were no longer worried about getting their money back because the government said, we guarantee it.
And so that's why I proposed and urged Congress to fully fund the American Dream Down Payment Fund. This will use money, taxpayers' money, to help a qualified low-income buyer make a down payment.
Well, greed has to be balanced with a certain amount of fear, and that's what down payment rules are all about, and amortization rules, is to keep people from carried away by, as you say, the greed of expecting to become rich by buying a home and reselling it at a higher price.
And that's important. If one of the barriers to home ownership is the inability to make a down payment, and if one of the goals is to increase home ownership, it makes sense to help people pay that down payment.
This is the problem, the moral hazard. We gave a moral hazard to home buyers. Once you say that you can buy a home with no down payment, all of a sudden there's no risk to the borrower. He doesn't care if he overpays, because if the house keeps going up, he makes money. If it stops going up, the bank loses the money. You know, we have moral hazards in our banking system. The U.S. government guarantees all bank deposits. Well, what does that mean? That means that depositors don't care what the banks do with their money once they deposit it, because they know the government guarantees it.
And the federal government obviously has to play an important role, and we will. We will. I mean, when I lay out a goal, I mean it.
Why are they doing that? Why can't we let mortgages be financed in the private sector? The reason is because the private sector would not finance these crazy mortgages, and real estate prices would have to come down to levels that people can actually afford.
How can you promote home ownership if people can't afford the home?
The big banks dared to make riskier loans because they had started repackaging loans and selling them to others as securities. They sold them to each other, to Fannie Mae and Freddie Mac, and they sold them to Norway, to Germany, and to China. If the loans turned bad, someone else would end up with a hot potato.
I guess we're a little early. What do you want to do?
Anything but inspect this temple of capitalism.
Oh, Nick.
Look at them. Their eyes popping out of their heads, drooling over the very things that are taking away their jobs.
Now, Nick, don't get all excited. My family think that America is a pretty swell place, and I don't want you to disillusion them.
I know.
Everybody wanted to buy because the rating agencies that rate securities gave the mortgage-backed bonds their highest rating. They promised huge payoffs at near zero risk. The rating agencies thought that house prices would just keep rising. And then there was that minor detail that the rating agencies were being paid by the sellers of the securities.
And I think the process was corrupted. First of all, the government licenses Moody's and Standard & Poor's. So there's only a few companies who are authorized to rate these bonds. So it wasn't really a free market. The government was in bed with Moody's and with Standard & Poor's. But also you had this perverse relationship between Wall Street and the rating agencies, where they were paying the rating agencies to rate the products that they were structuring. And so there was, this was an incestuous relationship where they knew if they put bad ratings on them, they wouldn't sell. And if they didn't sell, they wouldn't be making all this money constantly rating them.
They were great days, but it was all based on a market on steroids. Loans were cheap enough to keep driving housing prices up. But when interest rates returned to normal levels in 2006, the spell was broken. But for one person, the future was still bright. Ben Bernanke, Alan Greenspan's successor as Federal Reserve Chairman.
Tell me, what is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis.
People could no longer get new loans to pay off the old ones. Those who had been given a mortgage despite a very low income couldn't afford to stay. The prices started falling, making the mortgage-backed securities increasingly worthless.
There's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy.
The rating agencies removed the high ratings from the securities. Investors who never looked beyond the ratings suddenly didn't know what they had bought. They didn't know how risky those loans were.
Overall, the U.S. economy appears likely to expand at a moderate pace over the second half of 2007, with growth then strengthening a bit in 2008 to a rate close to the economy's underlying trend.
The dominoes started falling. Investors stopped buying mortgage-backed securities and refused to lend to those who depended on them. Investment banks like Bear Stearns and Lehman Brothers suddenly couldn't get new loans to stay in business. Fannie Mae and Freddie Mac could no longer hide the disaster. The financial crisis started in a way that is eerily similar to today's situation. It started with an economic crisis in the US and a government that responded decisively. After 9/11 and the dot-com collapse, the US government decided to save the economy by inflating a new bubble. Today, the world is trying to get out of the financial crisis by inflating a new bubble. The difference is that this bubble is much bigger.